Nobody sits you down and explains that the financial rules change when your income does. There's no orientation, no notification, no moment where someone pulls you aside and says, the way this system works is about to be completely different for you. And if you do not know that, it is going to cost you. That conversation does not happen. You are just supposed to know. And when you do not, you find out the hard way. A bill you were not expecting, a penalty that appeared from nowhere, a tax return that came back owing instead of refunding, and you have no idea why. Because you did the same things you have always done, except that the same things do not work the same way once your income crosses certain thresholds. This video is about the specific rules that change when you start making real money, not theoretical rules, not edge cases for the ultra wealthy, but the actual mechanics that affect people the moment a side hustle starts generating real income, or a freelance business takes off, or a salary hits a level where the old assumptions stop being true. 6 rules that nobody explains, all of them expensive to discover on your own. 1. The tax you did not know existed. When you work for an employer, there's a tax called FICA, Social Security and Medicare. You pay half of it. Your employer pays the other half. Your half shows up on your pay stub as a deduction, and most people barely notice it because it was always just there, already taken out before the money reached them. When you become self-employed, when you freelance, when you run a side business, when you consult, when you sell products, when you drive for a platform or rent out a property, something changes. There's no longer an employer to cover the other half. You now owe both halves, the full amount, all of it. That is 15.3% of your net self-employment income on top of your regular income tax rate, not instead of. In addition to, most people who start making real money through self-employment have no idea this is coming. They see the income, they set aside what they think is a reasonable amount for taxes based on their past experience as a W-2 employee, and then tax time arrives and the number is significantly larger than they expected. Not because they miscalculated their income tax, because they forgot or never knew that a separate tax existed that doubles the rate on that specific type of income. The self-employment tax is not optional. It is not a penalty for success. It is the structure of the system. But the system does not announce itself. It expects you to already know, and most people do not know until the first time they owe it. There's a partial deduction available. You can deduct half of the self-employment tax you pay as an adjustment to your income. That helps. But it does not change the fundamental fact that your effective tax rate as a self-employed person is meaningfully higher than your effective rate as an employee earning the same gross income. The math is different. The planning has to be different. 2. The system assumes you already know to pay quarterly. When you work for an employer, taxes are withheld from every paycheck. Money leaves before it reaches you. The government receives it throughout the year in small, regular installments. You never have to think about this. It happens automatically. When income arrives without withholding, self-employment income, freelance income, investment income, rental income, significant bonuses, the assumption flips. The system now expects you to send money to the IRS 4 times per year in estimated quarterly payments. April, June, September, January, regardless of whether anyone told you this was required, regardless of whether you knew the schedule existed. If you do not make these payments and your total tax liability for the year exceeds a certain threshold, you are charged a penalty. Not a significant penalty, but a real one. And more importantly, you face a large single payment due in April that you were not necessarily saving for, because the mechanism that forced you to save, the withholding from your paycheck, is no longer operating. Most people who transition from employee to self-employed, or who develop significant income outside their job, discover the quarterly estimated tax system the same way. They skip it the first year because they did not know it existed. They owe a penalty. They are told about the system retroactively at the worst possible moment, and they spend the rest of their working life managing something that, had they known it existed from the beginning, would have been entirely manageable. The deeper issue is that the quarterly system requires you to project your own income, to estimate what you will owe before you know what you will earn. For people whose income is irregular or unpredictable, this is genuinely difficult. There are safe harbor rules that protect you from penalties as long as you pay a certain minimum based on your prior year liability. Those rules exist. Most people who need to know about them do not know about them until they have already triggered the situation that makes them relevant. 3. Almost nobody actually understands how tax brackets work. There's a persistent and expensive misconception about the federal income tax bracket system. The misconception goes like this. If your income pushes you into a higher bracket, more of your money gets taxed at the higher rate. Not just the income above the threshold. All of it. This is not how it works. But a meaningful portion of working adults believe that it is. And that belief has consequences, including the belief held by some people that earning more money can result in less take home pay, that a raise or a bonus can actually hurt you, that there is a ceiling where additional income stops being worth pursuing because it will all be eaten by taxes anyway. None of this is true, but believing it shapes behavior. Here's how it actually works. The federal income tax system is marginal. That means only the income that falls within a given bracket is taxed at that bracket's rate. If you earn income that crosses into the 22% bracket, only the dollars above the threshold into that bracket are taxed at 22%. The dollars below it are still taxed at the lower rates they always were. A higher marginal rate never applies to income you already earned at a lower rate. What this means practically is that a raise is always worth taking. Additional income is always net positive from a tax standpoint. Your effective tax rate, the actual percentage of your total income that goes to taxes, will always be lower than your marginal rate because the lower brackets are always filled first. In 2026, with inflation adjustments applied, the bracket thresholds have shifted. For most middle income earners, those shifts are modest but meaningful. Knowing where the thresholds sit helps you make decisions about retirement contributions that reduce taxable income, about the timing of income if you have any control over it, about what you are actually keeping from a raise versus what you assumed you were keeping based on a misreading of how the brackets function. The misconception about brackets is not a sign of ignorance. It is the product of a system that is never clearly explained, but the people who understand it make better decisions because they are not afraid of earning more. 4. Capital gains taxes change at certain income levels, and most people do not know where those levels are. When you sell an investment, stocks, a fund, a piece of real estate, and you make a profit, that profit is typically subject to capital gains tax. The rate depends on two things: how long you held the asset and what your total income looks like for that year. Short-term capital gains on assets held less than a year are taxed as ordinary income at your marginal rate. Whatever bracket you are in, that is what you pay. Long-term capital gains on assets held more than a year are taxed at a separate, lower rate. The rate is 0, 15, or 20%, depending on your income level. Here's where it gets important for people whose income is growing. The thresholds for long-term capital gains rates are tied to total taxable income. In 2026, a single filer with taxable income below approximately $48,000 pays 0% on long-term capital gains. 0. That is not a typo. Below that threshold, qualified long-term gains are not taxed at the federal level. As income rises, that rate becomes 15%, and at very high income levels, it becomes 20%. There's also an additional 3.8% net investment income tax that applies above certain thresholds. What this creates is a set of decision points that most growing earners never think about because nobody told them these thresholds existed. If you are in a lower income year, a year between jobs, a year with significant deductions, a year where other circumstances reduced your taxable income, it may be an ideal time to recognize capital gains at a lower rate or even at 0. If you are in a high income year, the calculus changes. None of this is complicated once you know it exists. All of it is invisible until someone explains it. The people who understand it plan around it. The people who do not discover it retroactively at tax time when the decisions are already made. 5. Retirement accounts have income limits that most people never check until they are over them. The Roth IRA is one of the most powerful retirement savings vehicles available to most Americans. You contribute after tax money. It grows tax-free. Withdrawals in retirement are tax-free. The math on a Roth IRA held over decades is significantly favorable compared to most taxable alternatives. But there is an income limit. If your modified adjusted gross income exceeds a certain threshold, your ability to contribute directly to a Roth IRA phases out. Above the limit, you cannot contribute at all. In 2026, that limit for single filers begins phasing out around $150,000 and eliminates the direct contribution entirely around $165,000. For married filing jointly, the phase out begins around $225,000. Most people who are building their careers and growing their income are not watching these thresholds. They contribute to a Roth IRA the way they always have, and then one year, the year income crosses the phase out line, they contribute anyway without realizing they are no longer eligible. And at tax time, they discover they have made an excess contribution, which comes with penalties and requires correction, or alternatively, they never know the limit was crossed. And the contribution sits there, not getting caught for years, compounding a problem that was preventable from the start. There's a legal workaround called the backdoor Roth, contributing to a traditional IRA and converting it, but that strategy has its own rules and considerations. The point is not that high income earners cannot access Roth benefits. The point is that the rules change, that most people do not know when the change is coming, and that the penalty for not knowing is real. The same dynamic applies to other retirement vehicles: contribution limits, income phase outs, deductibility rules for traditional IRAs. All of these shift depending on where your income sits and whether you have access to a workplace retirement plan. The system is designed to be navigated, but navigating it requires knowing it exists. 6. The standard deduction math changes when income rises, and not always in your favor. When you file your taxes, you make a choice. You either take the standard deduction, a fixed amount that reduces your taxable income without requiring you to document anything, or you itemize, listing your actual deductible expenses and claiming whatever total exceeds the standard deduction. For most people in most years, the standard deduction is larger. Itemizing makes no sense. The standard deduction is simpler and it wins. But as income rises and financial lives become more complex, a mortgage, significant charitable giving, large state and local tax payments, business expenses, the calculus sometimes shifts. And the people who do not know to check, who assume the standard deduction always wins because it always did, may be leaving a deduction they are entitled to on the table every year. There's also a less obvious direction this can cut. Some deductions are limited or phased out at higher income levels. The deduction for state and local taxes is currently capped at $10,000, regardless of how much you actually pay. Certain itemized deductions that were fully available at lower income levels become partially or fully unavailable as income rises. The alternative minimum tax, the AMT, exists specifically to prevent high earners from using deductions to reduce their tax below a certain floor. The result is that the relationship between income and taxes is not linear. It does not simply scale up in proportion. There are thresholds, phase outs, limits, and alternative calculations that can shift your actual liability in ways that a basic understanding of the system does not prepare you for. And those shifts tend to appear the first year that income crosses them, always as a surprise, never as a warning. What to actually do with this? None of these rules are hidden. All of them are technically available in IRS publications and tax guidance. The problem is not secrecy. The problem is that the system never announces when you have entered the territory where these rules apply. It simply applies them and then presents you with the result. The people who navigate this well do three things that most people do not. They treat taxes as a year-round activity, not an April event. The decisions that affect your tax liability, retirement contributions, investment timing, business expense documentation, estimated payment schedules, all happen throughout the year. By April, most of those decisions are already made. You are just reporting them. They find out what threshold they are near before they cross it. Knowing that you are approaching the Roth IRA phase out or the capital gains rate change or the quarterly payment requirement allows you to plan, not after the fact, before. And they ask the specific question most people never ask their accountant: given my income trajectory, what changes in the next year or two that I should be preparing for now? Not what did I owe last year? What is coming that I do not know to expect? The tax code is not designed to penalize people who are making more money, but it is designed to be navigated. And the people who have always had more money have always had people helping them navigate it. The people who are building it for the first time often do not, which is why the same rules feel fair to one group and blindsiding to another, not because the rules are different, because the preparation is. If this opened up a question about your own situation, drop it in the comments. And if you want more on the financial mechanics that nobody explains when your income starts to grow, subscribe, because this is exactly what we cover here.